Amortization is the loss of value of the intangible assets like goodwill. So in that case, you will have that. Then again, we'll also have the interest expenses. Now the interest expense, remember, it is incurred on the debentures, and which in this case is part of the financing. So in this case, you will have to add it here. Then you go to less it on the what? On the financing activities. Then we'll also have the interest income. The interest income. Interest income is also what we call the investment income. Now investment income, in this case also, you will also be required to less that, it was included on that as income. So in that case, it's part of investing. We'll be also able to do it on the same. We also have the profit on disposal of the assets. All disposal. Profit on disposal is an income. So in that case, you'll also be able to less. And then there is also loss on disposal. Loss on disposal. So for the loss on disposal, in that case also, you will be able to add on the same. Then after that, you will also be able to go to what we call the working capital changes. The working capital changes. So working capital changes, in this case, is when we talk of working capital, is just the current assets minus the current liabilities. And therefore, the only items that we'll be basing on is the inventory, the receivables, and the payable. So in that case, you just look for the increase or the decrease. The increase stroke decrease in inventories. So if in this case it is a increase, you less. If it is a decrease, in that case, you'll be able to add. The same case to the receivables. You look for the increase stroke the decrease in receivables. So remember, these are current assets, and therefore the same case, increase you less, decrease in that case you add. And then the last one is on the payable. Remember, it's a liability. You look for the increase or the decrease in payables. So increase or the decrease in payables, in that case again, you look for the, if it's an increase, you add. A decrease, you'll be able to do what? You less. An increase, you add, because this is a liability, which is now the vice versa of what we've done on the current assets. So after that, what you get here is the gross cash flows from operating activities. So the gross cash flows from operating activities. Then after that, in this case, you can now less the tax that was paid during the year, the tax paid, and after lessing the tax paid, what we'll now be able to get here is now the net cash flows from operating activities. That is the net cash flows from the operating activities. So that is on the part of the cash flows from operating activities. So once you're done with the cash flows from operating activities, now you'll be able to go to the cash flows from financing activities. Not financing, but investing activities. From investing activities. The cash flows from investing activities. Cash flows from investing activities, I've said that the one that deal with the capital expenditure. And in this case, we will have the sales proceeds from disposal of assets. In that case, you will have the value there. Then again, if there is also a purchase of non-current assets, the cash proceeds again from that purchase of non-current assets, in this case also, you will also be able to do what? To less, because once you purchase an item, remember it's a cash outflow because you are paying. Then we have the investment income, or what we call the interest received. Now, the interest received in this case is this one that we were able to less it here. We less it because it is not part of the operations. Therefore, you're supposed to come and add it on the what? You add it on the investing. And after that, now in this case, you can get the net cash flows from investing activities. So we'll be able to get the value from that. So then after that, there is the last part, which is now the cash flows from financing activities. Now, cash flows from financing activities. The cash flows from financing activities that they are related to the sources of finance, and in this case, this is whereby we are having the ordinary shares and the debentures. So if in this case the company issues shares, the issue of shares, remember once you issue the shares, you are receiving the cash, and therefore in that case you will add that value. Then again, there is also the issue of debentures. You issue debentures, you receive also cash. So in that case, if you issue debentures, you also add the same. Now there is also loans borrowed. Now for the loans borrowed, remember you borrow a loan, you are increasing the cash, and therefore in that case you will add them. Then if there is loans that are paid, in that case, remember you are paying out, so you less the loans paid. Then there is this interest expense. Remember, it's an expense that will be incurred on the loans, and therefore the interest expenses will also less them from there. Remember, interest expense can also be the finance cost. And then the last one is now the dividend paid. Now, dividend paid in this case, they are paid to the ordinary shareholders or the debenture, the preference shareholders. Therefore, they are expenses that will be incurred on the financing. And after that, you can now get the net cash flows from financing activities. The net cash flows from financing activities. Now, after you get that now, you will also be able to get the net changes in cash and cash equivalent. The net changes in cash and cash equivalent. Now, for the net changes in cash and cash equivalent, you just take the net cash flows from operating You add the net cash flows from investing and net cash flows from financing. And then you'll also be able to add the beginning cash and cash equivalent, beginning cash and cash equivalent, then you'll be able to get the ending cash and cash equivalent. Be able to get the ending cash and cash equivalent. Be able to get the ending cash and cash equivalent. Now, how do you get the beginning and the ending cash and cash equivalent? In this case, you will be required to have what we call the cash and cash equivalent. Cash and cash equivalent. Whereby in this case, you'll be having the previous year, like for example, 2019 and 2020. So in this case, you only base on the cash and cash equivalent items. Whereby in this case, you can have the cash in hand. You will put the beginning and also the ending. Then we'll also have the short-term investment. The short-term investments. Short-term investment are also part of this. So you will also have the beginning and the ending. We'll also have the demand deposits. Demand deposits. We'll also do the same. You add them there. And then as at the end now, you can also have the bank overdraft, which this is a liability, and therefore in that case you less that and also less the same. So in that case, you will be able to get the values there. So in that case, these values that we get in this case, this is the beginning and this is the ending, of which when you take the net net changes in cash and cash equivalent, will be able to give you, when you add the beginning cash and cash equivalent, you are going to get the what? The ending cash and cash equivalent. Be able to get the ending cash and cash equivalent. So we can now try a question on the same. Remember, the only important thing in this case, you have to be aware of the format. So now, I want to do May 2018, that is question number 4B. And this is what the question states, that the following are the financial statements of the Olekina for the year ended 31st March 2018. We have Olekina income statement for the year ended 31st March 2018. That's where we have in the revenue, cost of sales, distribution cost, the administrative expenses, interest received, the interest paid, we have the tax, then we have the profit after tax. Olekina Limited will be given the statement of financial position as at 31st March for 2017 and 2018. On the assets side, we have the non-current assets, property, plant and equipment, intangible assets, then we have the investments. Current assets, we have inventories, we have receivables, the short-term investments, cash in hand, which is giving us now the total assets. On the side of the equity and liabilities, for the equity, we have the share capital, share premium, revaluation reserve, we have the retained earnings, we have the non-current liability we have for the loan. The current liability in this case, we have the trade payable, bank overdraft, tax, and we have the total equity and liabilities. Additional information. During the year, the investment classified as non-current assets were sold. The proceeds of the sale of the investment amounted to 15 million. Fixtures and fittings with an original cost of 42.5 million and a carrying amount of 22.5 were sold for 16 million during the year. The following information relates to property, plant, and equipment. We have the cost, accumulated depreciation, and we have the carrying amount. Carrying amount is also the net book value. 2.5 million ordinary shares of shillings 10 per value were issued during the year at a premium of 2 shillings per ordinary share. Then we have the dividend totaling to 40 million were paid during the year. Now you are required the statement of cash flows in accordance with the National Accounting Standard 7 statements of cash flows for the year ended 31st March 2018. So as I've said, in this case, you need to be aware of the format. And therefore, we can just do it using the format, and then we just be able to compute the computations that are required later after we're done with what is in the format. Now, the name of this company is Olekina Limited. So in this case, you begin with the name of that, and what you are required to prepare is the statement of cash flows. Statement of cash flows for the year ended 31st, this case is 31st March 2018. That is how you are supposed to begin with. Remember, we have the 3 categories of cash flows, and we will first begin with the cash flows from what? The cash flows from operating activities. Cash flows from operating activities. Now, cash flows from operating activities will begin with the profit before tax. Shillings are in millions. So we'll begin with the profit before tax. That is before you less the taxation. And when you take on the income statement, we've been given the profit before tax, which is after you've less the interest paid. And profit before tax in that case was 150 million. So in that case, you'll now go to adjustments. Adjustment, this is whereby we have in the depreciation. We'll be able to know how you can get the depreciation. The other thing is on the profit on disposal. Now, when you take on additional information, number 1, there was an investment that was sold. So we want to know whether it was sold on profit or loss. So in the non-current assets, the investment in that case were 12.5. But on additional information, number 1, they were sold for 15. Meaning, in this case, they were disposed of on profit. So we have the profit on disposal of investments. Which in this case is a value of how much? It will just be 15 million. You less the 12.5 million, where in this case is just 2.5. And therefore, remember, for the profit, in that case, we able to less. Now, the other one was on additional information number 2. We've been told that the fixtures and fitting with an original cost of 42.5 and a carrying amount of 22.5 were sold for 16 million during the year. So in this case, this is whereby you can draw what we call the disposal account. Disposal account. To know whether it was sold on profit or on loss. So disposal account, in this case, you are supposed to have the cost. In this case, you're supposed to have the accumulated depreciation. And in this case, you are supposed to have the sales what? Proceeds. Now, the cost of this machine, the fixtures, was 42.5. but we've been given the carrying amount, which is the net book value. And we know when you take the cost less the accumulated depreciation, what you get in that case is what we call the net book value, which we've been given the net book value. So when you take 42 minus the carrying amount or the net book value, you'll be able to get the accumulated depreciation, which in this case is supposed to be 20. So after that, we'll also have the sales proceeds, and it was disposed of for 16. So in that case, if the balancing figure is on this side, you remember it's supposed to be a profit. But in our case, the balancing figure is on which side? This side. So it is a loss of how much? It's a loss of how much? So it is a loss of, when I take my calculator in this case, what I'm getting there is a value of 42.5 minus 36, which is 6.5. So there was also loss on disposal of fixtures. Loss on disposal of fixtures, which in this case is 6.5. Remember, for that one, you will be able to add is an expense, which you can also get it by taking the net book value, you minus the what? The sales proceeds, which will be the same. Now the other one is on the trial balance, we have the interest received. Interest received, that is on the income statement, received. And the interest received in this case was given as a value of how much? The interest received was 12.5. So in that case, you will have the 12.5 for the interest received. In this case, we've said you less. Now we also have the interest expense. The interest expense. Remember, this is an expense that is not incurred on operating, it is incurred on financing. So in the same case, you will add it back for you to go and less it on the what? On the financing. So you add 37.5. So with that now, you can now go to the working capital changes. Working capital changes. So for the working capital changes, you check for the inventories on the trial balance, on the statement of financial position, you check whether they increased or decreased. So we'll begin with the first one, which is inventory. They increased. So the increase in inventory. They increased in year 2017, they were at 51. And in year 2018, we've been told that they are 75. And therefore, they have increased with 24. Remember, an increase in this case, you less. The same case to the receivables is also an increase. Increase in receivables. Increase in receivables. So receivables is increasing from 157.5 to 195. 157.5 to 105, which is an increase of 37.5, and therefore an increase in that case you less. The other one is the payables on the current liabilities, which is also an increase. Increase in payables. The increase in payables, it is from 59.5 to 63.5. 59.5 to 63.5, which is an increase of 4. Remember, an increase in payables, in that case, you add. And so, what you'll be able to get in this case is now the gross cash flows from operating. That is from operating activities. You leave it because there are some values that we are missing, we've not included. So after that, you can now less the tax paid. And how will you know the tax paid? We've been given the beginning year of 2017, the tax that was there, and the tax for 2018, that is on the current liabilities. So for the beginning of 2017, the tax was supposed to be, that was not paid was 55. During the year when you check on the income statement, the tax that was supposed to be paid was 70. But at the end of the year, we've been told that the remaining one is just 60. So in that case, you'll be able to know the tax that was paid. So it is 125 minus 60, which in this case, you're supposed to less 65. So what you'll be able to get here is now the net cash flows from operating activities. We'll be able to get that value. So after you've done with that, you can now go to the second one, which is now the cash flows from investing activities. The cash flows from investing activities. Now, cash flows from investing activities will have, for example, there is this disposal of investment. So it was disposed of for 15 million. So the disposal proceeds, that is the sales proceeds from disposal of the investment, which was 15. We have to put it there. There was also this disposal of fixtures. So we'll also have the sales proceeds from disposal of fixtures. Remember that is a cash in. So it was disposed for 16. So we'll add that. We'll also have the investment income, that is the interest received. And the interest received, I said you less it here, you come and add it here, 12.5. What is now remaining is maybe we'll also be able to identify once you draw the what? The trial balance, the PPE account. The other one is on the, when you check on the non-current assets, we are having the intangible assets under the PPE. Now, when you check on the intangible assets, on year 2017 they were 100, and on year 2018 they are 125. So from 100 to 125, the increase is as a result of purchase. So in that case, you will have the purchase of intangible assets, which is 125 minus 100, which in that case is 25. And remember, this is a cash outflow. You'll be able to less the same. So with that, we can also be able to get the net cash flows from investing activities. Net cash flows from investing activities. So in that case, we'll be able to do the same once we complete. Now the last one is now the cash flows from financing activities. Cash flows from financing activities. Now the cash flows from financing activities, in this case, we can have the shares. Now, when you check on additional information number 4, 2.5 ordinary shares of shillings 10 per value were issued. So meaning that in this case, there is issue of shares, which in this case is just the 2.5 you multiply by 10, which in that case is 25. When you check on the equity part, on the equity and liabilities, on the part of the share capital, we have 2017 was 75 and 2018 is shillings 100. So the difference of 25 is as a result of what? The shares that were issued. Now, the shares were also issued at a premium. The issue of shares at a premium. Now, in this case, we were told that they were issued at a premium of 2 bob, so 2 shillings. So if I multiply by 2, I'll be able to get 5, which is just the difference that we have been on the share premium, 75 to 80, is as a result of that. Now, the other thing, you go to the loan. It was 25, now it is 85. 2017 was 25, and 2018 is now 85. The increase is as a result of what? The loan that was done what? Borrowed. The loan borrowed. So it is 85 minus 25. 85 minus 25, which in this case will be 60. So it is an increase. Now there was this interest expense. It's supposed to be incurred in this case. So the interest expense will be able to less it from where? From this part, which was 37.5. And then on additional information number 5, dividends are paid out of shares, so we'll also be able to less the what? The dividend paid. Dividend paid, which was of 40 million. So in this case, there is nothing that is remaining for that part, so you can get the net cash flows from financing, which will be equals to how much? It's just 25, you add 5, you add 60, you minus that is 7.5, and you minus 40, which in this case is just 12.5. So from there, what will be required to get is now the net changes in cash and cash equivalent, which is just the total cash flows. And then from there, we'll be required to add the beginning cash and cash equivalent, beginning cash and cash equivalent, which now will be able to give us the what? The ending cash and cash equivalent. Ending cash and cash equivalent. Ending cash and cash equivalent. So now, in this case, we can get the cash and cash equivalent. Cash and cash equivalent. We have for 2017 and 2018. So you only consider those items are relating to the cash. We have on the current assets, we have the short-term investment. Short-term investment. And the short-term investment for the year 2017, there was nothing, and 2018 is 25. Now we also have the cash in hand. Cash in hand. And for the cash in hand, for 2017 was 0.5, and 2018 was shillings 1 million. And then we have the bank overdraft. The bank overdraft. Now for the bank overdraft from the current liabilities, this one was 49. Remember, it's an overdraft you less. For the 2018 is 42.5. Whereby in that case, you can now get the values. So in this case, this one will be negative 48.5. And that one 26 minus 42.5, which is negative 16.5. So beginning, which is 2017, beginning cash and cash equivalent should be negative 48.5, which should be able to give us the ending once you add the what? Once you add the net cash and cash equivalents. So we'll now be able to know the net cash and cash equivalent once we draw what we call the property, plant and equipment, so we can have the PPE account. The PPE account. We can also have the provision for depreciation. Provision for depreciation on PPE. So that is for the property, plant and equipment. Now, in this case for the PPE, we'll base it on cost. This one is on the accumulated depreciation. So we can now begin with what we've been given on additional information number 3. So as of the year 2017, the cost was 297.5. So the balance brought down is 297.5. And the balance carried down will also be given on cost, which is 360. 360. For the accumulated depreciation, the same. The balance brought down we've been given there, which is 145. The balance carried down, the same, we've been given there. And the balance carried down is a value of 170. Now, there was this item of fixtures that was disposed. So in this case, because we are basing it on cost, we'll have to include that item that was disposed to eliminate that value. The same case to accumulated depreciation. As we have eliminated the asset, since it was disposed, we can also eliminate the what? We can also eliminate the accumulated depreciation, which was of 20. Now, the other thing that you also need to consider is the revaluation reserve on the equity. Now, when you check on the revaluation reserve, the revaluation, which is an equity, the balance brought down was 45.5. Was 45.5. But when you check on the carried down is 50. There was an asset that was revalued. And therefore, in that case is a PPE. So the difference in this case is as a result of what? PPE, which is 4.5. So you have credited the revaluation. So in this case, you will debit the PPE with revaluation. And the revaluation was of what? 4.5. The revaluation was of 4.5. And therefore, as a result of that now, you can now balance the asset. You can now balance on the same, the PPE. So in this case, it will be 360. You add 42.5, which in that case will be 402.5. 402.5. So you minus 297.5, you also minus 4.5, which in this case, the difference is 105. Now, if the difference was on this side is as if this company disposed that asset. But since the difference is increasing the asset, it is as a result of cash that was paid in order to purchase that asset. So in this case, we'll have on that part the purchase of PPE. The purchase of PPE, the cash that was paid, which was 100.5. So you less the same. Now this case also, we balance for the provision for depreciation. This is 190. This is 190. The difference again is as a result of depreciation increase, and therefore we'll be able to credit the depreciation, which is 45. And on this case, the depreciation is supposed to be added on that case of 45. There is nothing that is remaining, so with that now you can be able to get the values there. It will be 150 plus 45 minus 2.5 plus 6.5 minus 12.5 plus 37.5 minus 24 minus 37.5, then plus 4. The gross cash flows from operating is 166.5. You minus 65, whereby in this case, this one will be 101.5. That is the net cash flows from operating. The same you will also do for this, the net cash flows from investing, which is 15 plus 16, 12.5, minus 25, minus 100.5, which in this case is negative 82. So we can now get the net changes in cash and cash equivalent, which is the cash flows from operating. You add the investing, you add the financing. So in that case, I take 101.5, I add for the investing, I also add for the financing, which in this case, here I'm getting 32. So if I take 32, I minus 48.5, I'm getting the what? The ending, which in this case, that is how the cash flows do what? Balance. That is how the cash flows balance. And that is how you're supposed to present the same. So you can have a view of it. So in that case, you can have a view of it in 3 seconds. You can have a view of it in 3 seconds. Yeah, so that is how you require to do the same, and that's what we need to understand on the same. That's all on the part of statement of cash flows.